Sada dajem reč profesorki Lidiji Barjaktarević.
Zahvaljujem. Imam zadovoljstvo da pozdravim naše goste iz Poljske. S nama su naše kolege sa Ekonomskog fakulteta u Varšavi, sa katedre za finansije i bankarstvo, Dominika Fijalkovska, Marek Pauka i Pjotr Luti. Ja bih zamolila Dominiku da izađe i da održi svoje predavanje.
For the possibility to present our research during this conference, and thank you very much for the great hospitality that we feel during staying here. We have been conducting research on alternative investment market in Europe with the special concentration on the Polish alternative investment market, which is called Newconnect. And together with my two colleagues, Michał Muszyński and Marek Pauka, we are trying to answer if there is any relation between disclosure quality and the characteristic of Newconnect market issuers. First of all, I would like to explain what is an alternative investment market. These are markets specially designed for small and medium companies. These markets are launched on stock exchanges, but because they are tailor-made for small and medium companies, of course, the regulations are much more lighter. Especially the regulation concerning entering this market, but also regulation concerning mandatory disclosure. So the scope of this research that I am presenting today is to analyze the relation between disclosure quality and companies' financial characteristics. By disclosure quality, we mean the additional information that the companies disclose in annual statements. So from the theoretical model, we can be sure that there is positive relation between reduction of information asymmetry and transaction cost together with the increase of disclosure quality. Theoretical background also shows that disclosure quality, when it's higher, influences positively liquidity of stocks, and also could influence positively the cost of capital, both of equity and debt, and also allow to proper valuation, market valuation of issuers. The topic, of course, is not new. There are many research, especially from the US market, but also from Asian market, which focus on disclosure quality. Basically, we can divide this research in three main categories. One is disclosure quality and the cost of equity, but also the cost of debt. Disclosure quality and financial characteristic, and disclosure quality and corporate governance. The second and the third categories of this research show what is the relation of inside of company with disclosure quality. So, for example, if the size of company, the debt ratio of company, but also the shareholder and board structure influence the disclosure quality. The first category of this research shows what are the consequences of disclosure quality. So if the company discloses more information, does it influence on the cost of equity and the cost of debt? The answers, of course, are not clear, because the research on some markets shows that there is a positive and significant relation between the disclosure quality and the cost of equity and debt. But for example, the paper of Botosan and Plumley shows that the relation is not so sure, because it depends on the kind of report. There is a positive relation between annual report, but there is a negative relation between quarterly reports and disclosure quality. Well, I think that we pretty much are facing the same problem, that our companies, our listed companies, are not aware that they should disclose more information. So even of the main market of Warsaw Stock Exchange, the companies are not likely to inform investors and shareholders about, for example, the factors which influence the future performance and about the strategy. We have been conducting interviews with Newconnect participants, and we were asking them about the disclosing likeliness. And very often they answer that they don't want to put not mandatory information in reports, because then it encourages shareholders to contact them and to ask about the additional information. And these companies, basically, they are small, relatively small, so they don't want to be interrupted. So to develop the hypothesis for our research, we of course follow the articles published in this issue, and we find that on many markets there is a positive relation between issuer size and disclosure quality. There is also a positive relation between time listed of the issuer and disclosure quality, and also some research shows that there is positive relation between debt ratio and disclosure quality. The first problem is rather obvious, because of course the bigger the issuer, the more resources it has to prepare financial report. It is more important even of alternative investment market, where, as I said, most of the companies are small, so very often they have outsourced bookkeeping. Also, the specific characteristic of the alternative investment market is that the company has a kind of a babysitter. So there is another party on alternative investment market, which is called nominated advisor. It's a company who help issuers to enter the market, and then it helps to fulfill the disclosure obligation. Legal environment is like that, for example, in Poland, it is mandatory to have for at least first 3 years the nominated advisor. So also we thought that for young companies, it would be more likely to disclose more information, as it has this nominated advisor. With debt leverage ratio, the answers are also not so clear, because, for example, Ent and Max, they show that there is a positive relation between the leverage ratio and disclosure quality, but some researchers show that the relation can be negative, as if we have very leveraged company, maybe it wants to increase information asymmetry between the issuer and market participants. So basically, we developed three hypotheses. First is that there is a positive relation between disclosure quality and the firm size. The second one, a negative relation between disclosure quality and firm listed period. And the third, there is a negative relation between disclosure quality and leverage ratio. Sample and data collection, we collected information data from annual report for the year 2011. From over 400 companies, we have chosen 231. We decided to choose the company with the highest stock return. We had to exclude some of them because there was a lack of information. So finally, we have been left with 200 issuers, for which we took data, financial data from Notoria Service. It is the Polish provider of financial data of stock companies. But to create the disclosure quality index, we hand collected data from financial reports. So our dependent variable is the disclosure quality index. Is the index well known in the literature? Basically, we had a checklist with over 70 questions, and if we find the answer for the question in report, we put 1, otherwise we put 0, and on this basis we scored the index. So this is how it worked. To analyze the hypothesis, we use 3 explanatory variables. First one is the natural logarithm of assets value to fix the issuer size. Then we have debt to EBITDA as a leverage ratio, and we use also time, the number of years listed on the Newconnect to see the listing story of the company. We add some additional variables: return on assets, return on equity, total debt to total assets, and natural logarithm of revenues. So these are summary statistics. It's not so interesting, I think. The only interesting thing is that the disclosure quality index is really low, because the maximum point was 9, and as you can see, the mean and median is slightly above 2. These are correlation analyses, and you could see the positive significant correlation between disclosure quality index, natural logarithm of revenue and assets. On the basis of this correlation analysis, we exclude some variables which are very strong self-correlated. So this is the results of OLS regression of entire sample, and as you can see, we find a positive significant relation between debt ratio and asset value. We also split our sample into subsamples, and for the less profitability companies, we found the positive relation between the size of the company, so between the value of assets and disclosure quality index. But what is interesting here, we find also the inverse U-shaped curve for debt ratio and for disclosure quality index, which means that there is a center point to which there is a positive relation between disclosure quality index and debt ratio, but after this point, companies are not more likely to disclose information. It could mean that if the company are more and more leveraged, they are increasing information asymmetry, not to give the very bad impression to the market. Yes, also we have the sum sample here of the youngest company. So as you could see, there is a negative relation between return on asset and disclosure quality index. Probably those companies want to make very good impression on the market because they are planning to collect more money in the future. And to have this possibility, they disclose more information to be more attractive for the market participants. Here we have similar relation. This is the part of companies which have the biggest income grow, and as you can see, these relations are similar because we have a positive relation with asset size and also inverse U-curve relation between debt market ratio and disclosure quality index. So just to sum up, there is a very clear positive and significant correlation between asset size, so the size of the company, and disclosure quality index. We predict that this is because of outsourced bookkeeping. So if the company is large enough to have inside accounting department, the disclosure quality will be higher. Then there can be also another explanation that big companies, before being listed, they have outside shareholders, also institutional investors, which demand to have a better quality disclosure. We also find this inverted U-curve, a relation between debt ratio and disclosure quality. As I said before, to the certain point there is a positive relation, but after it, it's negative. This first part, the positive relation, can be explained by that the company which have a higher debt ratio, they know that in the future when they won't collect money, it won't be possible from the credit institution, but right from the market. So they want to be attractive, but under the certain point there is a negative correlation to increase information asymmetry. Okay, thank you very much.